With rising interest rates and cooling demand, Toronto downtown real estate unit sales and prices are falling. However, it's not all bad news for the real estate market, so stick around to the end because as always, I've got the numbers to prove it.
Well, you boys are going to sit and watch this. This is what really matters.
The current supply on the market has dropped to 1,321 units, which is a drop of about 10% from the previous month, but still an increase of 32% over the previous year. So why is the inventory starting to fall? This is most likely due to the seasonal trend, as historically this time of year, the inventory drops as sellers are busy with their summer holidays. You can see from this historical graph that inventory drops like this pretty much every single year except in 2020 due to the pandemic. You can also see that the current inventory isn't that high compared to the period of 2010 to 2017, meaning that sellers aren't panicking yet as they did during the pandemic.
Not bad, huh?
However, it's still slightly on the higher side if you compare it with the same time period in the past 6 years. As you can see from this graph, the inventory has started dropping after increasing for weeks. But based on the historical trends, the listing inventory should be increasing again in September.
Oh man, here we go.
As you can see from the active listing distribution, there hasn't been much change from the previous month. But you can see there are a few more listings in the lower price points. There were only 431 sales in July, which is about a drop of about 45% compared to last year. This is the lowest July in 12 years. The last time it was lower than this was in 2010.
Damn!
This graph proves that sales have been steadily decreasing since the Bank of Canada started aggressively raising interest rates starting on March 2nd, 2022. The list price sales price ratio, a demand indicator, is now back down to 98.4%. It's back to the 2020 lockdown levels, meaning that condos are selling for less than their asking price. In the previous videos, we used the listing days on market, which was not the most accurate measure as agents cancel and relist their properties. However, there is a more accurate measure called the property days on market, but unfortunately, it's not broken down for condos in Toronto downtown.
Oh, that's great.
I'll talk about this more in a comprehensive market video I'll do of the GTA, so stay tuned. In July, the listing days on market were 22 days. It is taking a lot longer to sell your condo these days, and if you're overpriced, you're not going to be selling at all.
Don't you even think about it.
Average price in July dropped to $792,195, or a 10% drop from the high in March. However, compared to last year, it's still up by 5%. This is still on a downward trend though. Median price has dropped to $725,000 in July, which is comparable to the fall of last year. This is actually up from the previous month by about $4,000. It's a 7% drop from an all-time high in February, but compared to last year, it's still up by 5%. However, August is looking like it's coming down again.
Oh boy, here we go.
July HPI has dropped to $824,750 from a high of March of $896,650. which is a drop of about 8%. If you look at it still compared to last year, it's still up by over 17%. But this is also still on a downward trend. If you saw my previous video, I really lost faith in the HPI number because the metrics actually changed. What's interesting to note is that before September 2021, it was falling pretty much the same value as the median price. But after that, it's decoupled and the HPI seems to be having a much higher value. Many people like to use the median price metric to dictate the market value as it eliminates the outliers. I'm starting to steer more into this camp as well.
Hey guys. Hey. What's up?
Here's a chart of all the unit types broken down so that you can know specifically what unit types are selling for. As you can see, the studio, 1-bedroom and 1-bedroom plus dens are still priced higher than 2021. But the larger unit prices are comparable now, pretty much at the same price. The Toronto downtown condo market is definitely cooling and prices are coming down. This will likely continue as interest rates continue to rise. To counter this will be the dropping supply, which is currently happening right now.
What's happening?
As mentioned earlier, most likely you'll start to see inventory starting to increase in September, so I do expect the prices to come down even more. On July 13th, the Bank of Canada raised rates by 1%. We are expecting another rate hike on September 7th of at least 0.5% or possibly 0.75%. This will support my hypothesis that the market will continually cool. Now let's dig into the rental market. The rental market is on fire right now. If you watched my previous video, we saw this coming months ago, and now we're at the peak of it.
I am impressed.
There are just 988 active rental listings on the market right now. That's a drop of more than 31% compared to last year. We've seen inventories this low before in 2017 and 2018, as you can see from the historical graph before. As you can see from this cluster here, that inventory has been somewhat balanced for the past 3 months. Here's a current distribution of rental listings. You'll see where most of the active listings sit from this graph. So if you're looking for something under $2,000, you're really out of luck.
Good luck.
There were 2,456 leases completed in July. Surprisingly, this is a drop of 30% compared to last year. But as you can see that July 2021 was a complete outlier as demand surged with tenants moving back into the downtown as lockdowns ended. However, this is still relatively high compared to the past 6 years. As you can see from the weekly distribution, we've seen a pretty consistent high demand during the past few months. Historically speaking, the demand should start coming down as we head into September and the winter months. The list price rent price ratio is now at 103.57%. The competition is insane and landlords are getting multiple tenant applications as soon as they are listed. Many tenants are offering more than the listing price to get their applications accepted. Therefore, we are seeing this number higher than 100%. Days on market dropped to just 8 days. I want to note that vacant properties are still getting leased immediately. The reason why we're not seeing just 1 day on the market is because a good portion of the properties are tenanted and not available right away. So it takes a little bit longer to rent. So to put things into context, this is pretty much as low as it gets. If you recall from the previous listing inventory graph, even at the lowest points in 2017 and 2018, we saw 9 to 10 days on market. The average price is now at another record-breaking high of $3,020. The median price is also at a record high of $2,750. Compared to last year, they're both up by over 20%.
That's Gucci, baby, that's Gucci.
You are seeing inflation at play as more dollars are chasing fewer goods as there was over $500 billion injected into the economy during the pandemic. In addition, with the increasing interest rates, many would-be buyers are now opting or forced to rent for longer. Combine this with the low supply, and this is what you get.
That one's a sorry.
However, as we get into the slower rental months, the rental prices should stabilize. The housing problem has been made worse by our incompetent government introducing rent controls. So you can thank them.
What are you?
An idiot sandwich.
Thank you, Catherine Wynn. I don't want to go down this rabbit hole as I'll address this in a future video, but if you're someone who likes to think for themselves and likes to learn, then read Basic Economics by Thomas Sowell.
Smart man.
Here's a chart of the breakdown of rents across different condo types, in case you're wondering what rents for different condo types are going for. As you can see, all categories are up significantly compared to the previous years. Now, let me explain to you the PR ratio. This metric is similar to the PE ratio or the price earnings ratio for the stock market. Basically, this is a metric to show the investment value of properties. The lower the PR ratio, the better the investment. I simply took the current rents, converted them to a yearly number, and then divided them by the price.
Well, thank goodness for you.
Benchmark price divided by the median yearly rent. Average price divided by the average yearly rent. Median price divided by the median yearly rent. So let's take a look at these numbers. HPI PR ratio in July was 25.94. The current average price PR ratio is 21.35. Last but not least, the current median PR ratio is 21.55. You'll notice that everything seems pretty consistent until the HPI went off the deep end as mentioned previously. So moving forward, I'll be showing more love to the median price rent ratio, as this seems to be most consistent out of the three metrics. As the PR ratio comes down, real estate will become more attractive as an investment vehicle, even in light of the higher interest rates. Of course, interest rates do play a huge factor into your overall investment analysis, and the PR ratio doesn't address this component, as most buyers do use leverage to buy. However, this is just a similar metric to track the investment potential, just like we do in the stock market. If they have one, so can we.
You're goddamn right.
Now, in conclusion, we are seeing prices coming down, but they are still higher than they were last year. Inventory isn't building up as quickly as it did during the lockdowns in 2020, which is a good thing if you're a property owner. So this is somewhat counterbalancing the drop in demand. However, with further rate hikes, we will see the prices coming down further, which brings about a rare opportunity to pick up some Toronto real estate at depressed prices. I don't know how many more of these opportunities we'll see in my lifetime, but as prices fall and rents rise, there will be a point where it will start making sense to jump back into the market again, and then by then, hopefully the investment numbers start making sense. I would much rather pay a lower price and a higher rate than the other way around.
Oh, really?
Why? Because interest rates can come down, which increases my overall returns. Prices, not so much based on history, and just overall inflation. And as we head deeper into a recession, the only play Bank of Canada will have is to reverse rates. But first, our brilliant leaders must get inflation under control, which will eventually happen, as it's a year-over-year number.
I hear Canada has a pretty handsome prime minister.
It's Trudeau.
Once they start to reverse policy to stimulate the market to get us out of the recession they put us in, the cycle will start all over again. Forgive me for my brevity, as I know I've just opened up multiple rabbit holes, but I won't be going down them in this video, as this will make the video hours long.
This is taking too long. I'm gonna run out of beer.
Bad markets create opportunity. At the same time, it fleshes out the mistakes. Hopefully people will learn this time around, but I'm not too optimistic because of our flawed human nature. For those of you who know where I'm coming from, listen up, because we could be heading into one of the most opportune times to buy real estate in Toronto, which we may never be able to see again for a long time. You thought it was expensive before? Wait till inflation completes this infestation of the real estate market after the Bank of Canada starts to reverse policy. But in the meantime, we're going to feel the pain of higher interest rates and a slowing economy.
And winter is coming.
Winter is already here. I'll end with one of my favorite quotes by the legendary investor Warren Buffett. Be fearful when other people are greedy, and be greedy when other people are fearful. Do you agree or disagree? Let me know in the comments below. And stay tuned as we explore this uncharted territory. I'll see you in the next video.